Right, let's talk about something truly thrilling: tax penalties. Specifically those delightful little notes from the Internal Revenue Service, or IRS, as they're grimly known in the States. Nobody likes getting mail from the tax man, especially when it's not a refund check, which, let's be honest, feels rarer than a politician keeping a promise. These penalties are the IRS's way of saying, "Oi, you've made a bit of a boo-boo." Or sometimes you've made a rather massive, expensive boo-boo and we've noticed. It's their version of a yellow card, only it costs you actual money, not just a booking in the referee's little book. Understanding them is the first step to avoiding them, so lean in. Now these penalties aren't a one-size-fits-all kind of punishment. Oh no. The IRS has a veritable pick-and-mix selection of ways to sting you. There are penalties for filing your tax return late, which is like being fined for handing your homework in after the bell. Then, there are penalties for paying late, which is, well, fairly self-explanatory. And let's not forget the accuracy-related penalties. These pop up if you've been a bit, shall we say, creative with your numbers, or simply made an honest mistake. It's a whole smorgasbord of financial OEs, each designed to make your wallet noticeably lighter, if you're not careful. You might wonder why these penalties even exist. Is the IRS just a bit mean? Well, probably. But the official line is that they're there to encourage everyone to play by the rules. Think of it as a system designed to nudge, or rather shove, taxpayers towards being timely and accurate. The entire tax system, a magnificent, creaking, bureaucratic beast, relies on people paying what they owe when they owe it. Let's delve a little deeper into the financial ouch factor of these penalties. It's not just about the initial charge, the headline figure that makes you spill your tea. The direct impact is that your tax bill, already an unwelcome guest, gets substantially larger. Imagine planning your budget, thinking you've got it all sorted, and then, wham! An extra few hundred or even $1,000 gets slapped on top. That's money that could have gone towards, well, literally anything more enjoyable than enriching the government's coffers due to an error. It's a direct hit to your disposable income or even your essential funds. Then there's the particularly delightful feature of interest. Yes, not only do you get penalized, but the IRS often charges interest on the penalties themselves, and on the unpaid tax, naturally. It's like a debt that breeds, creating little baby debts to keep it company. This interest can accumulate surprisingly quickly, turning what might have seemed like a manageable penalty into a growing financial headache. It's a bit like quicksand. The longer you're in it, the deeper you sink. The IRS isn't known for its generous lending terms, let me tell you that much. It's a relentless compounding beast. This unexpected financial burden can throw a massive spanner in the works of your carefully laid plans. That family holiday you were saving up for? Might have to be a weekend in a caravan instead. The down payment on a new car? Pushed further into the future. Even just managing monthly bills can become a struggle when a hefty IRS penalty suddenly appears. It's a ripple effect. The penalty payment isn't just a one-off hit. It can destabilize your financial well-being for months or even years, depending on its size and your ability to pay it off quickly. And in more serious, albeit less common scenarios, persistent unpaid taxes and penalties can lead to more aggressive collection actions from the IRS. It's not just your bank account that takes a beating when the IRS decides you've misbehaved. Oh no, the emotional toll can be just as significant, if not more so for some people. Picture this. You're going through your post, expecting a postcard from your Auntie Dot, or perhaps a catalog for things you don't need. Instead, you find a stark, official-looking envelope. Your heart does a little nervous flutter. You see the return address, Internal Revenue Service. That flutter turns into a proper thud. It's rarely good news, is it? The stress of simply receiving that letter can be immense. And that initial shock is often just the beginning of a rather unpleasant emotional journey. There's the gnawing anxiety that comes with uncertainty. What does this notice mean? How much will it cost? Have I done something terribly wrong? Will I end up on some sort of tax offenders register paraded through the streets? Probably not that last one, but your mind can wander. This worry can hang over you like a dark cloud, affecting your mood, your sleep, and your general ability to enjoy life. It's a constant, unwelcome background hum of tax trouble. Then there's the sheer frustration and the colossal waste of your precious time. Dealing with IRS penalties isn't usually a quick 5-minute job. It can involve hours spent trying to understand complicated tax jargon, digging out old records you thought you'd never need again, and potentially long, soul-destroying phone calls navigating automated systems. All this time could have been spent doing something productive, or even just something enjoyable like watching paint dry, which would genuinely be more fun than arguing about Form 1099 Miss C discrepancies. It's a drain on your energy and your patience. Right, tax deadlines. Not exactly the highlight of your year, are they? But the American taxman, the IRS, is frightfully keen on them. Think of that big date, usually mid-April. It's not just a polite suggestion, you see. It's a rather firm, unyielding deadline. Miss it and you've got their attention, and trust me, that's not the sort of attention you want. They expect your forms promptly. No excuses, really. Now, what happens if you're fashionably late? Well, the IRS has a little something called the failure to file penalty. Sounds ominous, doesn't it? It is. It's usually a percentage of the unpaid tax you owe, calculated for each month, or part of a month your return is late. It starts ticking from the day after the due date, so every day counts against you. They really don't like waiting. It's their money after all. Or so they think. And believe me, this penalty can add up. Quickly. It's not just a slap on the wrist with a wet lettuce leaf. It can be surprisingly substantial, a real kick in the financial teeth. Especially if you also owe a fair bit of tax. Beyond the fine, there are hidden costs of delayed tax returns. It's not just the immediate penalty you need to worry about. Oh no, the consequences of late filing spread further, like ripples in a rather murky pond. For instance, what if you're actually owed a refund? Many people are. A nice little check from Uncle Sam. Well, if you file late, that refund gets delayed, obviously. The IRS isn't going to rush to give you your money, not if you haven't bothered to send them your forms. No paperwork, no lovely refund, simple as that. Then there are other financial goodies you might miss. Certain tax credits or deductions have strict filing deadlines. These are designed to save you money, reduce your tax bill. But if you saunter in late with your return, you might find you're no longer eligible. Poof! Gone. That's money you could have claimed, just vanished. Because you missed the boat. It's like leaving free money on the table. And nobody wants to do that, do they? And let's not forget our old friend interest. The IRS loves charging interest. It's practically a hobby for them. If you file late and owe money, you'll likely pay interest on the unpaid tax. But wait, there's more. You can also be charged interest on the penalties themselves. Yes, interest on penalties. So, how do you avoid this late filing nightmare? It's not rocket science, thankfully. Just a bit of planning. First things first, know your deadlines. Crucial. For most folks in the US, it's April 15th. But this date can sometimes shift a day or two. Weekends, holidays, that sort of thing, always double check. Write it on your calendar. In big, bold, unmissable letters. Set reminders on your phone. Tell your dog. Whatever it takes to remember. Next up, get your financial ducks in a row. Early. Don't wait until the week before the deadline. That's just asking for trouble, stress, and mistakes. Start gathering your documents well in advance. Your W-2 forms from your employer. Any 1099 forms for other income. Receipts for things you might want to deduct. Having everything ready makes the whole process smoother. Less panic, more peace of mind. Consider the wonders of modern technology. Right then, let's wade into another delightful corner of the tax maze: underpayment penalties. This isn't about sending your forms in late, like we discussed before. Oh no, this is a whole different kettle of fish, or perhaps a different bucket of bureaucratic slime. This penalty rears its ugly head when you haven't paid enough tax throughout the year. Or, if you haven't paid enough by the specific payment deadlines the IRS so kindly sets. It's their way of saying, hold on a minute, sunshine, you've been a bit light on the contributions, haven't you? It's a punishment for not keeping up with your tax obligations as you earn. So, how does the IRS conjure up this penalty figure? It's not plucked out of thin air, though sometimes it might feel that way when the bill arrives. Typically, the penalty for underpayment of estimated tax is based on the difference between what you should have paid and what you actually paid by each quarterly deadline. They also factor in how long that money remained unpaid. And of course, they'll apply an interest rate, because why miss an opportunity to make things just a little bit more expensive? The calculation can seem fiendishly complex, designed by someone who truly enjoys spreadsheets and making ordinary people weep. But why, you might ask, do they get so worked up about this? Why can't you just settle up in one lump sum when you file your annual return? Well, the American tax system operates on a pay-as-you-go principle. This means the government expects to receive its cut of your income throughout the year, not just in a big bonanza after 12 months. Think of it as them wanting their pocket money in regular installments rather than waiting for a birthday windfall. This regular flow of cash keeps the government machinery ticking over, funding all those essential services like, well, funding the IRS itself. Ironically enough, and here's a particularly sneaky bit that catches many people out, you can actually face an underpayment penalty, even if you end up getting a tax refund when you finally file your return. How does that work, you wonder? It's because the penalty is assessed on whether you paid enough tax on time during each specific payment period. So if you underpaid significantly in the first 3 quarters, but then made a massive overpayment with your final tax return filing, that late overpayment doesn't necessarily wipe out the penalties for the earlier shortfalls. The IRS looks at each period. It's a detail, but a costly one to overlook. Section 2. Dodging the deficit strategies for accurate tax estimation. Ensure accurate tax withholding from your paychecks using Form W-4. Too little withheld, and you risk an underpayment penalty. Too much, and you're giving the government an interest-free loan. Freelancers and small business owners need to make estimated tax payments. Calculate your expected tax liability and pay quarterly. Use the IRS tax withholding estimator for guidance. Adjust your W-4 or estimated payments after major life changes. Section 3. When estimates go awry, rectifying underpayments and seeking waivers. If you realize you've underpaid taxes, pay the additional amount quickly. Review any IRS notices carefully and consider requesting a waiver if you have reasonable cause. Accurate record keeping and professional advice can help manage underpayment penalties. Navigating the labyrinth of IRS paperwork. Messing up the paperwork is a classic blunder. The IRS has a form for everything, each with baffling instructions. Using the wrong one causes confusion and delay. Typos, especially in your SSN, can lead to rejections. Always use the correct current version of any IRS form. Read the instructions, double-check details, and consider using tax software or a professional. It's an investment in accuracy and your own sanity. Section 2. The quarterly quagmire dodging estimated tax deadline disasters. Missing estimated tax deadlines is common, especially for freelancers and small business owners. The IRS expects quarterly payments on April 15th, June 15th, September 15th, and January 15th. Mark these dates in your calendar and set reminders to avoid penalties. Use accounting software and set up automatic transfers to a tax savings account. This ensures you're prepared when the deadlines arrive. Section 3. The Phantom Paycheck Unmasking Unreported Income Errors. And now for another classic, the grand old mistake of not reporting all your income. This isn't necessarily about nefarious, deliberate tax evasion, though that's obviously a massive no-no. Often it's about genuine confusion or oversight, especially in today's world of diverse income streams. Perhaps you do a bit of freelance graphic design on the side, sell crafts online, drive for a ride-sharing service occasionally, or earn some interest from a savings account you'd almost forgotten about. Every single one of those little streams of income? Yes, the IRS wants to know about it. They have a remarkable ability to sniff out unreported earnings. You see, the IRS has a rather clever system of information matching. When a business pays you more than $600 for freelance work, they'll likely send you a Form 1099 NEC. And guess what? They send a copy to the IRS too. The same goes for interest and dividends from banks and investment firms. Form 1099 INT or 1099 DIV. If the income reported by these third parties doesn't show up on your tax return, alarm bells start ringing in the IRS's vast computer systems. It's like leaving a trail of digital breadcrumbs leading straight to your undeclared earnings. They are surprisingly good at connecting these dots. The consequences of failing to report all your income can be quite unpleasant. Firstly, you'll owe the back taxes on that income, which is fair enough. But then come the penalties, often an accuracy-related penalty for substantially understating your income. And let's not forget our old friend interest, which will be charged on both the unpaid tax and potentially the penalty itself. What might have seemed like a small omission can quickly balloon into a much larger financial headache. It's always better to be upfront and report everything, even if it means a slightly higher tax bill initially. It's certainly cheaper than getting caught out later. So the golden rule here is meticulous record keeping. Keep track of all your income sources, no matter how small or infrequent they may seem. Use accounting software, spreadsheets, or even a dedicated notebook. Reconcile your records with any 1099 forms you receive. If you're unsure whether something counts as taxable income, it's always best to err on the side of caution or seek advice from a tax professional. Understanding what constitutes reportable income, from bartering goods and services to cashing in cryptocurrency, is crucial in this increasingly complex financial landscape. Section 1. The horse's mouth. Tapping into IRS resources, if you dare. Right then, let's talk about getting help directly from the source, the Internal Revenue Service itself. Now, I know what you're thinking. The IRS, helping me? Isn't that like asking a wolf for sheep herding tips? And yes, their primary business is, after all, extracting money from you. However, believe it or not, they do offer a rather vast array of resources designed to help you get your taxes right. Their website, irs.gov, is the main gateway to this treasure trove, or perhaps Pandora's box, depending on your luck and patience. It's a sprawling digital labyrinth packed with information, forms, and tools. Navigating it can sometimes feel like an archaeological dig, but there are genuinely useful nuggets to be found if you persevere, or if you have a very strong cup of tea and a resilient spirit. Amongst the digital reams of text, you'll find some rather clever interactive tools. There's the Interactive Tax Assistant, which asks you a series of questions to help clarify specific tax situations, like whether you can claim a certain credit, or if a type of income is taxable. It's a bit like a choose-your-own-adventure book, but instead of fighting dragons, you're battling tax code complexities. Then there's the Tax Withholding Estimator, which we've touched upon. This is particularly handy for employees wanting to make sure they're not going to get a nasty surprise, or give Uncle Sam an interest-free loan. These tools won't file your return for you, but they can certainly illuminate some of the darker, scarier corners of your tax obligations, which is a start. Then we have the publications. Oh, the publications. The IRS publishes an almost biblical number of guides and leaflets on every conceivable tax topic. Publication 17, Your Federal Income Tax, is the big one, a veritable doorstop of tax information. There are publications for retirees, for small businesses, for people with income from selling their Beanie Baby collection. You name it, there's probably a PDF for it, filled with dense prose and enough caveats to make a lawyer blush. Finding the right one and then deciphering its contents can be a Herculean task, but if you have a specific, obscure question, the answer might just be buried within one of these documents, probably on page 37, subsection C, paragraph 4, footnote 12. And of course, there's the good old-fashioned telephone. Yes, you can actually try calling the IRS. I say try because patience is not just a virtue here, it's a bloody necessity. You might be treated to some truly uninspired hold music for what feels like an eternity. However, if you do get through to a human being, they can sometimes provide direct answers or guidance, especially for less complex issues. Just be prepared with your questions, have your tax information handy, and perhaps a stress ball. Whilst it can be frustrating, sometimes a direct conversation is what's needed to cut through the bureaucratic fog, even if it takes half your morning to achieve it. Sometimes you need to admit that you're out of your depth, and that's perfectly all right. Tax law in the States is notoriously complex, a constantly shifting beast. If your financial situation involves more than just a simple W-2 from your employer, it might be time to call in a professional. There are several types of tax professionals out there, each with their own specialties and capes, metaphorically speaking. Choosing the right type depends on your specific needs and the complexity of your situation. Section 3. The fruits of your labor. Enjoying a penalty-free existence. The grand prize? Peace of mind and financial relief. Imagine not stressing over official envelopes. Picture a calm tax season, confident everything's in order. Sleep soundly, free from tax anxieties. Save money and avoid penalties. Every saved dollar is a victory. Free up mental energy and time. Focus on what truly matters. Reach for financial stability and reduce stress. Your future self will thank you. Maybe tax season will be less terrifying. Section 1. Recapping the minefield key penalties revisited. So, we've been on a bit of a journey, haven't we? Through the thrilling, occasionally terrifying landscape of IRS penalties. It's a place where a missed deadline isn't just a minor oversight, it's an open invitation for a rather unpleasant financial kicking from Uncle Sam. We've seen how simply filing your tax return late can land you squarely in rather hot water. The Internal Revenue Service, bless their bureaucratic cotton socks, really don't appreciate being kept waiting for their paperwork. It's somewhat akin to being late for a very important dinner with a very punctual, very powerful, and undeniably very hungry relative. They'll tap their watch pointedly, they'll raise a disapproving eyebrow, and then, inevitably, they'll send you a bill for your tardiness. And then, of course, there's the unadulterated joy of the underpayment penalty. That particularly special financial sting reserved for those who haven't quite managed to cough up enough of their hard-earned cash throughout the calendar year. It's all part of their pay-as-you-go system, which sounds wonderfully modern and convenient until you realize that go often means go directly to Penaltyville if you miscalculate your dues. We've peered into the murky, complicated depths of how these penalties are meticulously calculated. It's frequently a confusing and bewildering blend of percentages, fluctuating interest rates, and what can only be described as bureaucratic dark arts, seemingly designed to make your head spin and your wallet considerably lighter. It's effectively a punishment for not being a sufficiently accurate fortune teller with your own income. Beyond these rather prominent headline acts in the penalty circus, we've also cautiously poked our noses into other common pitfalls that await the unwary taxpayer. There are the simple yet potentially costly typographical errors that can cause considerable chaos. Using the incorrect form for your specific situation, which is rather like bringing a delicate teacup to an aggressive sword fight. You might make an impression, but it probably won't be the one you intended. Or perhaps conveniently forgetting to inform the IRS about that little bit of extra income you happen to make selling your slightly used, yet surprisingly valuable collection of vintage garden gnomes online. Each of these seemingly small, insignificant errors can attract unwelcome attention and, more distressingly, unwanted bills. It's a veritable obstacle course of potential financial pain, meticulously laid out for your inconvenience. The absolutely crucial takeaway from all of this, the point I really want to hammer home, is that these penalties aren't just imaginary monsters lurking under your bed. Oh no, they are very real. They possess rather sharp teeth. And believe me, they can bite incredibly hard if you give them half a chance. Understanding this fundamental truth, truly grasping the stark reality of these potential financial sanctions, is the absolute first and most important step towards avoiding them. This isn't about being scared into abject submission by the tax authorities. It's about being smart. It's about knowing the intricate rules of their rather complicated game so you don't accidentally commit a foul and find yourself on the receiving end of a hefty, unwelcome fine. Knowledge, in this admittedly dull but undeniably important arena, really is power, or at least penalty-avoiding power. Section 2. The Proactive Path to Peace Strategies for Smooth Sailing. The American tax landscape can be a minefield, but you're not helpless. Be meticulously organized. Know your deadlines. Keep scrupulous records of income and expenses. File your tax return on time, even if you can't pay immediately. Use tools like Form W-4 correctly. Make quarterly estimated tax payments if self-employed. Use IRS resources and consult professionals when needed. Take control of your tax situation and reduce stress. Approach tax season with a clear plan and strategy. Section 3. The Sweet Taste of Compliance. Beyond just avoiding fines. Tax compliance brings peace, relief, and financial benefits. Avoid penalties, sleep soundly, and enjoy more of your money. Reclaim time and energy for what truly matters. Be organized, informed, and penalty-free. Cheers to a stress-free tax season.